Investing is a great way to make your money work for you and grow your wealth over time. It can be intimidating to get started. With the right guidance and strategy, investing can be a rewarding and profitable venture. This video will discuss the basics of investing, dispel common myths, and provide aspiring billionaires essential tips for starting their investments. When investing, it's important to set financial goals and understand the risks involved. Different investment options include stocks, bonds, mutual funds, and exchange-traded funds or ETFs. Knowing the basics of risk and return will help you decide which investments are right for you and your risk tolerance. There are different types of investment accounts, such as retirement accounts and brokerage accounts. Asset allocation is an important part of diversifying your investments and reducing risk. Lastly, there are different investment strategies, such as dollar cost averaging and value investing, that can help you reach your goals. Welcome to Bear Luxury, a channel dedicated to helping you reach success. Our videos provide valuable tips and insights on goal setting, productivity, mindset, and more. Whether you're still striving for personal or professional success, we're here to support you on your journey. Don't forget to subscribe and hit the notification bell to never miss on an upload. Today, we'll take a closer look into investing and how it can get you closer to your goal of becoming successful faster. The information presented in this video is for educational and informational purposes only and should not be considered financial or investment advice. Investing involves risks, including the potential loss of principal, and past performance does not guarantee future results. Any investment decisions you make are your own and should be based on your research and analysis. It is important to consult with a qualified financial advisor or professional before making any investment decisions. The views and opinions expressed in this video are solely those of the presenter and do not necessarily reflect the views or opinions of any affiliated companies or organizations. Now, although there are no standards when it comes to investing, there are still some guidelines we could give you to make sure you have a more pleasant journey toward financial success. Setting financial goals. Setting financial goals is an essential step in managing one's finances effectively. It involves identifying what you want to achieve financially and creating a plan to reach those goals. Financial goals can vary from short-term goals like paying off credit card debt or saving for a vacation to long-term goals such as buying a home or planning for retirement. It is crucial to have specific, measurable, achievable, relevant, and time-bound goals, or SMART, to ensure that you can track your progress and stay motivated. To set financial goals, start by examining your current financial situation, including your income, expenses, debts, and savings. Then, determine what you want to achieve, both short-term and long-term. Consider factors like your age, income, and lifestyle when creating your goals. After setting your financial goals, develop a plan that includes a timeline and specific actions you will take to achieve them. It is essential to review and adjust your goals periodically as your financial situation changes. By setting financial goals, you will have a clear roadmap to guide your financial decisions, increase your financial security, and achieve your financial aspirations. Investment options. Investment options are avenues that individuals can explore to grow their wealth and secure their financial future. There are numerous investment options available, each with its own unique set of characteristics, risks, and rewards. The most common investment options include stocks, bonds, mutual funds, real estate, and commodities. Stocks are a form of equity investment where you can purchase a stake in a company and their returns are based on the company's performance. Bonds, on the other hand, are fixed income investments that involve lending money to a company or a government and receiving interest payments over time. Mutual funds are a diversified investment option where a group of investors pool their money to buy a portfolio of stocks, bonds, or other assets. Real estate investing can include buying physical properties or investing in real estate investment trusts, or REITs, which are companies that own and operate income-generating properties. Commodities such as gold, oil, and agricultural products are also popular investment options that offer potential diversification and inflation protection. While each investment option has its own set of pros and cons, diversifying one's portfolio across various asset classes is generally recommended to minimize risks and optimize returns. Investment options require careful consideration of your financial goals, risk tolerance, and investment horizon. Seeking the advice of a financial advisor can help you make informed decisions and develop a well-rounded investment portfolio. risk and return. Perhaps one of the most important points to cover on our list is understanding risk and return. It is, after all, one of the main determinants on whether you should invest in something or not. Risk and return are two fundamental concepts in finance that are closely related. In the world of investment, risk refers to the potential loss of principal or investment return due to uncertainties or adverse effects. Meanwhile, return refers to the income or gain that an investor receives from an investment. Investing in higher risk assets such as stocks, bonds, or real estate can potentially yield higher returns than investing in low risk assets such as savings accounts or government bonds. However, higher returns come with higher risks, and investors must be willing to accept the possibility of loss. The concept of risk and return is often represented by the risk-return trade-off, which suggests that investments with higher than expected returns require a higher level of risk. Investors who are risk-averse or have lower tolerance for risk may choose to invest in lower risk assets, such as treasury bonds or certificates of deposit. In contrast, investors who are more risk-tolerant may choose to invest in higher risk assets such as stocks, venture capital, or cryptocurrency. To manage risk and maximize returns, investors often diversify their portfolios by investing in a mix of different asset classes, sectors, and geographical regions. By spreading their investments across various asset classes, investors can potentially reduce the overall risk of their portfolio while still achieving their desired results. Investment account types. Investment account types refer to various types of investment vehicles that you can use to save and grow their money. Some common investment account types include individual retirement accounts or IRAs, 401k plans, brokerage accounts, and mutual funds. Each account type has its unique features, tax implications, and investment options. You must choose the account type that aligns with your investment goals, risk tolerance, and financial objectives. You should also consider factors such as fees, investment minimums, and account restrictions when selecting an investment account type. Asset allocation. Asset allocation is as important as understanding risk and return, and it is a crucial component of a sound investment strategy. It refers to the process of diversifying investments across different asset classes, such as stocks, bonds, and real estate, based on an individual's financial goals, risk tolerance, and investment horizon. By diversifying across asset classes, you can spread the risk and optimize returns while mitigating the impact of market volatility. The first step in determining an optimal asset allocation is to establish a clear understanding of one's investment goals. This includes determining the desired rate of return, time horizon, and risk tolerance. For instance, an individual with a long-term investment horizon and high risk tolerance may choose to allocate a higher percentage of their portfolio towards stocks, which typically offer higher potential returns but also come with greater risks. Once you have identified your investment goals and risk tolerance, the next step is to select the appropriate asset classes. Stocks, bonds, real estate, and alternative investments such as commodities and hedge funds all have their unique risks and returns. Determining the right mix of these asset classes requires careful analysis and consideration of factors such as historical performance, current market trends, and economic conditions. You must monitor and periodically rebalance their portfolios to ensure that their asset allocation remains aligned with their goals and risk tolerance. Over time, changes in the market and your personal circumstances may require adjustments to the asset allocation to maintain an appropriate balance of risk and return. Asset allocation is a critical component of a successful investment strategy. By diversifying across asset classes, you can minimize risk and maximize returns while staying aligned with your financial goals and risk tolerance. Investing in consultation with a financial advisor can help ensure an appropriate asset allocation and portfolio that meets one's financial needs. Finally, we have the investment strategy. Investment strategy refers to a systematic approach to investing that is designed to meet an individual's financial goals while managing risk. A sound investment strategy typically involves diversifying investments across different asset classes, selecting appropriate investments based on an individual's goals and risk tolerance, and regularly monitoring and adjusting the portfolio to maintain alignment with changing market conditions and personal circumstances. Successful investment strategies require careful planning and consideration of a range of factors, including an individual's financial goals, investment horizon, and risk tolerance. Of all these, which one do you think you'd have trouble adjusting to or learning? Let us know in the comment section below. Thank you for watching Bear Luxury. We hope you found the information and insights helpful in your investment journey. Remember, investing is a long-term game, and it is important to stay disciplined, patient, and focus on your goals. Keep learning, stay informed, and seek the advice of a qualified financial advisor when making investment decisions. With the right mindset and approach, investing can help you achieve your financial goals and secure a brighter financial future. Don't forget to subscribe to our channel for more investment tips, insights, and strategies. Happy investing!